Hi, I'm Joseph Khateri, realtor in the state of Virginia, and today I'm going to tell you the 100% guaranteed way to become a millionaire. Also, as you guys can tell, I'm kind of redoing some lighting around here, so if you notice some weird glitches or something, ignore it. Oh, and also make sure to stick around until the end of the video because I go over some advice that pretty much no other realtor or investor out there is going to tell you about how to grow and manage your wealth. And the way we're gonna do it today, index funds. But what are they? So index funds really just represent a type of investment vehicle, such as a mutual fund or an ETF. And the entire goal is to track the performance of a specific market. I'll give you some examples of this, but the most widely known is the S&P 500. And I'm sure you might have even heard your parents or your grandparents talking about it because it's very, very important. The S&P 500 is basically a reflection of the combined top 500 companies in the United States. So if you invest in the S&P 500, you're investing in all 500 companies all at once. But why should you bother with this? Why not just dump everything into Apple and Tesla and call it a day? Well, there are a few reasons, and one of the biggest is diversification. I mean, if you can just kind of think this one out. I mean, this one's a no-brainer. If you dump all your money in one or two companies, that's a lot riskier than dumping it partially into 500. The second reason is because it really is just passive. In fact, you can set up automations to just buy it and then not look at your accounts for 30 years and then look at it one day and go, oh, wow, it did this amount, great. Whereas, you know, if Apple releases a new crappy VR headset, everything kind of goes downhill. Also, according to a report from Morningstar in 2019, only 23% of people who actively, buy their own stocks actually outperform the S&P 500. So chances are, if you're just buying stocks that you like or you think have great potential value, 3 out of 4 times you are still going to lose money, at least versus these index funds. The second thing is the power of compound interest. The great Albert Einstein once said that it is the 8th wonder of the world, for a good reason too. Compound interest isn't just earning interest on money that you have in there. It's earning interest on the interest itself. It's snowballing. I mean, that's truly what it is. You roll down a hill and the snowball grows bigger and bigger and bigger until it's an avalanche. The same thing applies with your money. So let's just go through an example right now. Imagine you invested $5,000 every single year for an average of 8%. In all honesty, the stock market has averaged about 10%, but let's go conservative, let's go 8. Now, obviously, some years it's gonna do 30, some years it might go negative 10, but average of 8. In 30 years, with just 5K a year, your investment goes to over $600,000. That is insane to think about. Only 5K a year. And for those of you that can do mental math, 30 years times 5K a year is 150,000. But guess what? Now it's 600K. And if you wait just an additional 10 more years, so 40 years total, it is $1.3 million. Okay, and I know this is a big argument and a big reason people kind of go away from investing like this. They think,
I want my money now, or what am I gonna do with $1 million if it's 40 years in the future?
Think about it this way. Most of you have parents. My dad is 57 this year. If he started investing when he was 18 years old, keep in mind I'm 19, if he started investing when he was roughly my age, it has been 40 years already for him. He would have $1.3 million right now. And I'm sure that my father would be so crazy happy if his bank account had $1.3 million in it. Like, you are going to live to be your parents' age. I don't know why people don't fully grasp that, but imagine how happy your parents would be if they had $1.3 million saved up. Because that is going to be you when you're their age. And this is just from $5,000 a year investing. Think about if you could double that, which I know, you have to be in a fortunate position if you could, but it is exponential. The more you put in, it's only gonna snowball. Now, the third thing is being consistent.
Consistency?
That's honestly one of the most important things in this entirety. Because investing in these index funds isn't just a drop it one time and forget it exists for 30 years. That's not how this works. Instead of trying to predict when the market's gonna crash, when the market's at its peak, the highs, the lows, instead, you just want to dollar cost average. Because what people don't realize, timing the market, you will fail. Almost everybody fails at timing the market. That's just not really a thing that the average person can do successfully and consistently. What I personally recommend, figure out how much money you want to invest per year in the S&P 500 or index funds in general. It doesn't have to be S&P. So let's say you do $5,000 a year in your head. Cool, divide that by 12, and on the first of every single month, just invest that money. Doesn't matter how good the market's doing. It doesn't matter how bad the market's doing. Just invest it and forget it. By the way, everyone, if you're enjoying this video, please go ahead down below, subscribe. Almost everyone that watches my videos actually isn't subscribed. And I know we just passed 500 subscribers and I'm really aiming for 1,000. And of course, if you need a realtor, anywhere in the world you are, feel free to DM me. I check my DMs every single day. All right, and the fourth thing on the list is keeping your emotions in check. You gotta invest with your brain, not your heart. And the reason why this is such an important thing is because history. It really comes down to history. For example, the '08 crash, housing market collapsed, and guess what everyone did? They panicked at the banks, they sold their homes for way less than they were worth, and overall, if they simply held their positions, they held their stocks, they held their homes, toughened it out for the next 2 to 3 years, they would be on the upside of things. The same thing applies to index funds. Investing in index funds and just stocks in general is going to be a roller coaster ride. I won't deny that. It will be. There will be ups, there will be downs, but they have to even out. I mean, you kind of have to just think of the stock market as human psychology at the end of the day, because that's all it really is. It's not robots trading. It's people. It's people's savings accounts. It's people's retirement plan. So when you have a huge array of factors from even physical events, something bad happens in the news, panic happens, your first instinct, I gotta sell everything. It's difficult to not react emotionally when the market's so volatile. I completely understand that. Or let's say the opposite happens. Crypto wave comes in. Everyone has FOMO, fear of missing out, and they potentially buy these crypto coins that have no name, no value, whatever the case may be, for way more than they're worth. And people did that even with Bitcoin. People were buying at the height 60, 70K, and now it's worth 20 to 30 just because of fear of missing out. In 2017, a financial firm by the name of Dalbar actually performed a research report that basically stated exactly what I'm talking about. The average investor who picked their own stocks and handled their own money actually made less money, had less returns than the person who just let everything go. Over 20 years, the person who picked their own stocks and sold when they wanted to and bought when they wanted to made 5.04% per year. And the person who just did nothing but hold for 20 years made 7.68%. And that's why it's so important to focus on your long-term goals and not get distracted by the fluff, not make impulsive decisions, because the worst thing that you can do is pull out all of your money and then realize you screwed yourself 5 years later. All right, and the fifth thing, and this is more for people who already are invested, is rebalancing your portfolio. And I think this is a super overlooked part of things. You know how I mentioned to set it and forget it? That's generally true, but once you pass a certain point, you have a certain amount of equity in it, then you have to start managing and diversifying even more. And the reason for this is because your goals change. It's inevitable. Over a 30-year span, your financial objectives and your amount of risk that you can take is going to change. For example, right now I have most of my money in S&P 500 and also about 50% in a Vanguard tech index fund. And the reason for this, I believe tech has a lot more room to grow, and also the fact that I think I can handle the risk. It has extremely aggressive returns. It very much outperforms the S&P 500, but in return, it is made up of a smaller subset of tech companies, which means higher risk. It's inevitable. Now, let's say that I'm my father's age. I'm mid-50s. Do I want to be holding risk anymore? Probably not. So maybe it's time to sell off that tech index fund and invest more in something like bonds. According to a 2020 study by Vanguard, which is ironically the company I invest with, over an 89-year period, a portfolio that's 60% stocks, 40% bonds, and rebalanced annually would have a returned average of 8.8%. That is pretty good. Now, without rebalancing, where you change stuff up, it would have actually been a little bit higher at 9.3%, which you would think is a lot better. But the thing is, it was 50% more volatile in total. So it's all about how much risk are you willing to tolerate versus the returns. So there you have it. Now you should know the 100% guaranteed way to become a millionaire. It's not sexy, but it will work. The power of index funds. As always, if you found this video helpful, make sure to subscribe and hit the bell to receive updates on when I upload. And of course, if you need a realtor, no matter where in the world you are, feel free to DM me on anything. I literally check everything every single day. All right, have a nice day. I just played with my hair and that ruined things.